Hey traders, welcome back to the course. If you've been following along, you know that in our last session we laid the groundwork by understanding how the institutions are constantly looking for liquidity to execute their trades and positions. Today we're moving beyond basic concepts and onto timing precision entries and institutional context. This isn't about guessing where the market will go. This is about knowing why it's going there and, more importantly, where the major players are leaving their footprints. We're going to dissect two professional grade entry models that will help you pinpoint your entries with enhanced accuracy. But that's only half the battle. I'm also going to reveal how to stack the odds in your favour using three key confluence factors that most retail traders completely ignore. These are the tools that separate the consistently profitable from the crowd. Model 1, the stop hunt and large range candle entry. First up, let's talk about the stop hunt. The market needs fuel to move. That fuel is liquidity. Liquidity is found where orders are clustered, and a major cluster of orders exists just above recent highs or just below recent lows. These are the stop loss orders of breakout traders and the stop entry orders of short-term reversal traders. Institutional players, with their massive capital, know this. A stop hunt is a deliberate, often swift move to push the price to these levels, trigger those stops, absorb that liquidity, and then drive the market in the opposite intended direction. We can and should take advantage of this. Here's a step-by-step pattern you need to look for. Number 1. Identify liquidity. The first step is the most important. You must look for an old high or low that contains a build-up of stop-loss orders. The more obvious the low or high is, the more likely there's a pool of orders there for the smart money to use to enter their trades. In our case, Euro USD has formed a clear swing high, meaning this is a level that traders have been watching and referencing. The order book reveals a large cluster of buy stops have built up just above this high, which is also in close proximity to a psychological level, which is another key location where liquidity hides and accumulates. Number 2, the hunt. Watch as price pierces the level. This isn't a strong sustained breakout. It's usually a quick price spike forming a candle with a large wick, a momentary push to hunt the buy stops by the smart money. The wick forms because the smart money sell into the buy stop orders as price breaches the high. That allows them to aggressively enter their sell positions using the buy orders as counterparty for their sell trades. Number 3, the reversal. Immediately after price spikes to buy stops, the market aggressively reverses over the next few candles. This rapid shift in momentum and direction is key. It will often print a large range candle, also known as an ignition candle, back in the original intended direction the smart money wanted price to move in. This large range candle is the most important part of the entry model. It's a high probability signal that the stop hunt is over, the institutional positions has been filled, and the real move is now underway. The large body of this candle shows one-sided commitment from the institutions, and my data shows the lows or highs of these candles have an extremely low chance of being broken, provided they show a change above 0.14%. Entry. Your entry is triggered by the appearance of the large range candle. You have a few options depending on your risk tolerance. The best entry is to get in as soon as the large range candle closes. The signal is clear and you can jump in immediately. For a more conservative and potentially tighter entry, you can wait for a small pullback to the 50% level of the large range candle's body and then enter there. This often happens as the market digests the initial move, offering a slightly better price but with a higher chance of you potentially missing the move if price doesn't end up retracing. Stop loss. Your stop loss placement is critical and logical. It goes just above the high of the stop hunt wick for a short trade, or just below the low of the wick for a long trade. The reasoning is clear. If price returns to that level, your entire trade thesis that the move was a stop hunt is invalidated. You're out. This gives you a clear objective invalidation point. If another candle forms in your expected direction after the large range candle closes, move your stop to the low or high of the large range candle. The data shows the odds of price breaching this point are extremely low, and these odds increase the bigger the body of the large range candle is. Model 2, the refined order block entry. In our previous videos, we discussed supply and demand zones, and how the imbalance creating the zones often reveals smart money activity. Now, let's get surgical. An order block is the most refined, most precise version of that concept. It allows for an incredibly tight stop loss and a high risk to reward ratio. An order block is a specific candle, typically the last opposing candle, before an explosive move that breaks a key market structure. Think of it as the launch pad for a new trend. For a bullish move, it's the last down candle before the big push up. For a bearish move, it's the last up candle before the big drop down. Why does this work so well? The theory behind order blocks is the final opposing candle is where the institutional players loaded up their last big orders, sometimes called smart money orders, before letting the price fly in their intended direction. When price eventually returns to this very specific level, they will defend their original position, and any remaining unfilled orders will be triggered, causing a major price reaction. This is where you want to be entering. Entry. This model requires patience. You don't chase the move, you wait for the market to come back to you. The ideal entry is either a limit order placed right at the edge of the order block zone or a large range candle forming once price enters the area. This provides better entry confirmation at the expense of potentially missing the trade if no large range candle ends up forming. In our case, price spikes into the order block zone before reversing and producing a bullish large range candle. While the candle didn't form inside the zone, its appearance is still a valid long signal. The odds of its low being broken, which I mentioned before, still apply, and the fact that the candle formed due to the order flow inside the order block means it's still a part of the same setup. Stop loss. Your stop loss should be placed just a few pips beyond the order block zone for standard entries and below the low or high of a large range candle for confirmation entries. This gives you a decently tight stop loss, which in turn leads to a much greater risk to reward ratio. This entry model is not for the impatient, as you're waiting for price to retrace to a very specific area. However, when it does, it's usually a strong signal with potential rewards that are unmatched. Having a great entry model is good, it's a solid foundation, but if you want to take your trading from good to great, you have to understand the concept of confluence. Confluence is the art of combining multiple, non-correlated factors that all point to the same outcome. This is what creates an A-grade high probability setup. Factor number 1, Owanda's order book. This is an often overlooked tool that gives us a peek into the psychology and positioning of retail traders. The Owanda order book shows where Owanda's clients have their open orders and, more importantly, where their stop loss orders are clustered. Since retail sentiment is often a contrarian indicator, meaning retail traders are often on the wrong side of major market moves, we can use this information in the order book to our advantage. Before taking a trade, check the order book. Let's say you've identified a perfect order block supply zone on your chart, indicating a potential short trade. You then look at Owanda's order book and see a massive cluster of retail buy stop orders sitting right above your zone. What does this mean? It's a pool of liquidity, it's fuel, it's a perfect target for an institutional stop hunt which will push the price right into your order block zone. This adds a massive layer of conviction to your short trade. You're no longer just looking at a pattern, you're anticipating the institutional move to hunt those stops, and your entry model is perfectly positioned to capitalise on the subsequent reversal. Factor 2, psychological levels. The market isn't just a chaotic mess of numbers. It's also influenced by human psychology. Big, round numbers are particularly significant. Levels like 1.10 on Euro USD, 1.25 on GBP USD, or 150 on USD Japan are called psychological levels. Why are they important? Banks, institutions, and even automated algorithms anchor their orders around these clean, easy to remember numbers. They act as major areas of support and resistance. Your analysis should always include these levels. A demand zone is good, but a demand zone that forms perfectly on top of the 1.0800 psychological level is an A-grade setup. Price is much more likely to have a strong, sustained reaction from a level that is significant for multiple reasons. It's where supply and demand from multiple sources, technical analysts, human traders, and institutional algorithms all converge at once. Factor 3, key market data and probabilities. This is where we start to think like quants and data analysts. The market moves in patterns and has statistical tendencies. Understanding these can give you a critical edge that very few retail traders possess. For example, Bullish and bearish daily streaks. Let's say that you know historically GBP USD only has a 15% chance of having more than 5 consecutive bullish days, and today is day 5 as it approaches your supply zone. What does that mean? It means the odds are now leaning significantly in your favour for a short trade. The probability of a reversal is increasing with each passing day. Time of day. Volatility isn't constant. Major moves and stop hunts are far more likely to occur during high volume sessions like the London and New York Opens, when the biggest banks are active. Trading during the middle of the Asian session or during a major holiday can be a recipe for frustration. Knowing when to trade is just as important as knowing what to trade. Higher high and lower low odds. After a strong trend, what is the statistical probability that the next day will form another higher high? This type of data can help you decide if it's better to look for a continuation trade or to start anticipating a potential reversal. You can find this data through specialised services, or you can do your own backtesting. The point is to add a statistical objective layer to your analysis. It moves you from "I think this will happen" to "based on historical data and current conditions, there is an X% chance this will happen." That is a massive leap forward compared to how most traders are trading. Stop trading patterns in isolation. Start thinking in layers. Identify an entry model, then validate it with confluence. Does the retail order book support your idea? Is it at a key psychological level? Do the market stats and time of day add weight to your trade thesis? When you align multiple factors, you drastically increase your odds of success. This takes patience, discipline, and a commitment to doing your homework before you even click the mouse. Remember, a single tool is just a piece of the puzzle. The most profitable traders are those who can see the whole picture.